We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chris Vermeulen, founder and chief market strategist of the Technical Traders. How are you today, Chris?
I'm good, Tom. How are you?
Excellent. So, Chris, we've seen capital flows into the stock market versus the metals at times. And I wanted to start by kind of going through how you see these capital flows and, if they become a real risk off or on trade.
Yeah. So, I like to focus on the stock indexes like the SP 500 and figure out if money's flowing into the equities market or how it's flowing in. And from there, you can kind of gauge if money's flowing in, then you find out the hot spots. If it's flowing out, you got to find out where it's going. So if I was to kind of show you some charts here of kind of how I see these markets kind of unfolding, let me go to the kind of a long-term view. So the top chart here is the SP 500, and we'll just focus on this for now. More or less, we've got like bullish phases in the stock market where the market is rallying higher. It's in a strong technical move. Now, I should be clear. I focus on technical analysis 100%. I don't look at fundamentals. I don't watch the news. I don't get into politics and all that stuff or earnings. I strictly follow price. Price is either moving up, down, or sideways, and we either want to be in it, short it, or sitting on the sidelines. So when we look at this long-term view, we got the COVID crash over here. We went back into a bull market phase. Then there was a sell signal. We avoided the 2022 collapse kind of, and then we got back into the new bull market phase, and the stock market is back into a major kind of buy signal. Now, I do think there's a lot of struggling going on right here in terms of the price action. This is what I call this kind of sideways kind of consolidation through here, or you could argue it's kind of a rising channel, a bear flag. This, I feel like, is a major topping phase in the stock market, a stage 3 topping phase. So right now, money is rotating into that. And a really good way to give you a visual of this is to actually look at the stages that the stock market has. There's 4 stages. Stage 1 is a basing stage. Stage 2 is a bull market. Stage 3, which is where we are, is very choppy. It's very dangerous. And then you go into a stage 4 decline. And it's really important to understand where we are and what stage you're in because it requires a very different strategy, each one. We make a lot of money in bull markets. We make a lot of money in bear markets. These topping phases, which really growth stocks have been struggling with since about March of 2001. We've been in this topping phase, and this is kind of where we are, where we've been going up and sideways with the overall stock market. And I think it's just a matter of time before it rolls over, and then we go into a recession and a much bigger decline from there. And so that's kind of the look and feel of where we are. The setup we have right now is very similar to the 2007, 2008 kind of topping phase. Also, the tech bubble back in 2000. We're back into that same type of scenario. Those are the last 2 times that we had one of these stage 4 declines. And people forget, I think, how dangerous they are. In 2008, there was 6,500 suicides directly related to the drop in equity prices. So that goes to show how dangerous these bear markets are. People thought 2022 was bad. They have no idea what could be just around the corner and how it can devastate people's retirements, marriages, relationships. I mean, financial times, tough times ruin a lot of good things. So that's kind of the big thing to be aware about in the overall market. And if we're kind of to look over at what actually different cycles are doing, let's just quickly take a look here, just because these kind of link together.
Chris, if we could you go back to that chart real quick? I want to ask you about that moving average. What is that green line, and what is it? Is it a moving average?
On the infographic here?
No, on the actual SPY chart that you had up.
Okay, yeah, sorry. If we go here, so this is like the 150-day equivalent moving average. Typically, you want it to be sloping up. You want price to be above it. Based on stage analysis, which is right over here. If we look at stage analysis, it's based on Stan Weinstein's book, How to Profit in Bull and Bear Markets. More or less, this dotted line is like the 150-day moving average. And the general rule that he follows and that I follow is if price is consistently above the moving average and the moving average is sloping up, you're more or less in a bull market phase. If price is below it and the moving average is above it or starting to flatline or you're chopping through it, that means you're in some type of consolidation stage, either a stage 3 topping phase or a new base is being built before it goes higher. And then when price is consistently below it and it's sloping down in a steeper angle, you're most likely in a stage 4 decline. And then the cycle just rinses and repeats. So it's just looking at the overall trend, the long-term bias of the market is price more or less moving up? Is the ocean or the tide going up, or is the tide going down? And the reason I follow the stock market, the SP 500 specifically so closely, is because I find that if you know what the SP 500 is doing, then you know which asset class to be in. You can, if it's not favorable, we go and we look in different areas, different assets through a kind of a hierarchy that I follow. That technically, as you go down the hierarchy, it's an asset that moves slower and slower and slower, so that as things get riskier, you're actually moving into slower and safer investments. And 2022 was the year for the U.S. dollar play, to be long the U.S. dollar. I mean, it just screamed higher all year while stocks and bonds fell. This year, I mean, right now it's growth stocks. We're long, the NASDAQ, the SP 500. We're riding this up. But I don't think it's the start of a new major bull market. I think it's eventually going to run out of steam. The question is, how high is this going to continue to go? Are we going to put in a double top? Is it going to pierce a little bit higher? Or is it going to roll over, in the next week or two? The nice thing about technical analysis is that it doesn't really matter. We follow price. It has to change and confirm a new trend before we take action. So I don't have to worry about economic news or what the debt ceiling is going to be or all those different things. All we have to do is follow price and manage those positions. But as you can see, the price on average is above the moving average. It's sloping up. We've got, the market's moving higher, and you kind of have to still be long right here. But I do think we're going to eventually go into a swan dive where we could see a 20, a 40+% correction in the stock market, and it could get really ugly and take years to recover from.
So when we compare, let's say the SP 500 to the precious metals, whether that be, the metals themselves or let's say the miners even, do you see capital flows on let's say a time when people are getting out of the SPY or the general equities and see some of that capital coming into the metals or miners?
For sure. So what we've been seeing, so on the bottom of this chart here is when it's red, it means the stock market is not favorable. You don't want to own stocks. When it's green, you want to own stocks. And the top chart here is GDX, just as you mentioned. And here's the interesting disconnect. So when the stock market was out of favor on the bottom saying, hey, don't own stocks, we saw gold miners move up. And then as soon as the stock market became favorable and people piled back into equities and into tech, into growth stocks, everybody moved out of miners, doing the complete opposite of what the stock market more or less is telling us to do. Same thing happened. Stock market was out of favor. Gold miners led the way. They ripped higher. And then the stock market became favorable. Everybody eventually moved into growth stocks and out of the miners. So the complete opposite of what the market is doing. So when people are nervous in the stock market, they're actually finding precious metals and miners a safe haven, a defensive play, which falls back to this chart here of the actual economic and the stock market cycles. We got this blue cycle here, which is the stock market cycle. And then we got the yellow cycle, which is the economic cycle. And it always trails, it tops out after the stock market. And the reason being is investors see earnings in companies starting to slow. The next quarterly projections are lower. So investors start to sell stocks before that data actually confirms, and the stock market starts to go down. And so when the news actually comes, the economic data comes, the stock market's already down because they've already kind of seen that coming. It was already forecasted. And what's really important here is energy and precious metals are the last two kind of assets that do very well just before the stock market. Now, 2022, energy was the leader. It led the way higher. We saw oil hitting record highs, energy stocks hitting highs. This year, it's obviously been out of favor, but now it's rotated all into precious metals as that defensive play. And so both of these kind of have had their spot in the light here. Maybe precious metals are going to have another big rally and push higher again before the stock market fully tops. But this is exactly what we saw back in 2007, 2008. These two sectors did really well. And then the stock market went into a stage 4 decline. And then everything goes down. And that's the key that people don't realize. Just because it's performing well right now, it's really just a short-term move, because when we go into a full-on bear market, there's forced liquidation. People actually just get scared and they liquidate all positions. So that pulls precious metals and miners down. The nice thing about this is when we're in this late stage of a bear market, this is usually when gold and silver and miners come back to life. And I think that is going to be the start of the next major leg higher in precious metals. And the gold chart is really a really powerful looking chart. When we look at it, if we take a look at the gold chart, and especially if we go to the monthly, I mean, I'm really excited about the precious metal space. I've been waiting for this next major super cycle to happen. We have a very similar setup that we had right back over here. We kind of had that unfolding right here. And you could argue we're almost kind of still in that phase. But what we're looking at right now are these kind of topping candles. And it's pointing to potential downside for gold, silver, and miners for a few months. The stock market might go into a big sell-off. It's going to pull gold down. But after that, we're going to see this head up. I think it'll be $2,700 gold and beyond. And this type of bear market that I think we're about to go through could be very similar to what happened in 2008. We see gold pull back with the bear market. It bottoms before the stock market and it takes off and has a huge, huge move. So that's what I'm seeing in the precious metals space. And this is the monthly chart. So we're still potentially 3, 6, 8, maybe 12 months away before all this kind of comes to fruition and plays out. But we're right on the cusp. There's a lot more pain, I think, in these markets from this point forward. But as soon as that comes to an end, I mean, we are going to be off to the races for the next major move to the upside. So I'm pretty excited about the space, but I don't think it's going to quite happen this year. If anything, it would be like right at the end of the year is what I'm thinking.
Okay. So, Chris, you mentioned that the dollar, was really strong last year. As it regained some of that footing that we saw from the drop, it seems like that, typically affects the metals, right?
Yeah.
When we measure gold in dollars, if the dollar is going up, that means the metal is going down. So is this a fairly repeatable pattern, or can they go up together almost as a risk off type parity?
They can go up together. It's happened before. But if the dollar, I think, really rips to the upside, I think it'll be too strong of a force for gold to rally with it. Now, there might be some crazy play. I mean, obviously, we've had a bit of a banking crisis this year that sent gold higher. People are nervous to put their money in the bank. I mean, you're only insured for like 200 or 250K, which isn't very much for somebody with a large bank account. So people have been moving into precious metals as a physical asset, so they actually have something tangible, not just some zeros in an account that can vanish overnight. But I do think we're going to see the dollar come back up to these highs that we saw back in 2022, and maybe it's even going to blow off and go even higher to what we saw back during the last kind of super cycle, where precious metals put in a major bottom, the dollar put in a top, and as the dollar sold off, gold and commodities just screamed higher. So I do think we're going to get back with a high dollar. Typically, when the stock market sells off, we see the dollar rally. People cash out, they move to a strong currency, a country that they feel like is going to recover. And I think that's going to send the dollar higher. And it'll put a lot of headwind on gold. Maybe gold will hold up well. And that's why gold probably has held up very well is actually because it's a global asset. I mean, you look at gold, it's trading right up here near the highs, where gold miners are down like 35, 40%. So are silver miners. They're just not performing the same. And that's because gold is a slower moving asset. So it's more stable. You can put more money in it because it's not some crazy yo-yo. And the whole world moves into gold as a defensive play. Whereas I see gold miners and silver miners more specifically being an aggressive speculative hedge of kind of the buy and hope it's going to go to the moon, which eventually it probably will. But that big money isn't really flowing into that sector yet. It's, gold's holding up really well because it's a global asset. You can use it kind of to replace a bank account to some regard because it's a slow moving asset and it's physical versus a digital in the banking space.
Chris, you mentioned that energy and precious metals really, let's say, benefit at the top of that stock market cycle. Mm-hmm. Is oil, you think, due for another pullback along with that, that broader pullback in the stock market?
I think oil is it's on a slippery slope and it's on the verge of breaking down in a very big way. So if we were to look at this chart, you can see what happened to oil. It skyrocketed back in 2007, 2008 as one of those late commodity plays. It was leading the way higher. And then the bear market started and then oil got hammered. It was a great play until it wasn't. And it's all about managing those positions and knowing how to lock in profits and things like that. Now we're in a very similar phase here. We've seen oil blow off. It had a top, it pulled back, it came back up for a double top. It's fizzled out of favor. And we're really trading at a very important level here on this chart. This is kind of a pretty big and topping phase. It's actually very similar to what happened over here. We came up, it paused for about 4 months, it rallied up, and then it came down. It's hard to see. There's a little wick here, but there's a level right across here that once oil broke, it really picked up even more speed. And so that's where we are now. I think a lot of people see a recession around the corner. And once this level breaks, I mean, we're going to see oil, I think, slide, very easily. It could drop right back into the 35, 40 range. When you look at this chart pattern on the monthly chart. So I do think oil is on the verge of moving lower. It kind of had its blow off phase. And precious metals is kind of that last one. Gold is trading up near the highs on the verge of pulling back with this as well. So I'm pretty bearish on the energy space here, because when the bottom breaks, when this level is broken, oil is going to fall very quickly. Energy stocks, I think, are going to get hit really hard. And the fact that most stocks are trading lower, not participating in this rally is not a good sign. It's just a handful of technology. You look at the AI space. I mean, the AI is like saved the stock market from breaking down. We've got NVIDIA rocketing higher. The semiconductors, they're big heavyweights for the indexes. They're holding this market up, right? We got Tesla and we've got Apple. These big tech companies are doing really well. In fact, if we look at the banned hot list, which kind of tells us what the hottest sectors are to be in, the ARK ETFs are right up at the top with the technology space. That's telling me that the general public is thinking 2022 was the bear market. It's over. And they're piling back into these really aggressive growth stocks, which those growth stocks are struggling. When we go and we look at the ARK K ETF, which is like one of the most popular ETFs, and we just zoom out here, obviously it is down huge. It needs to rally like 5% to get back to the highs from 2021, but it's still trying to carve out a bottom. And the reality is, I do think this ETF, if we go into another bear market, is going to be worth about $14 to $16 a share. And people have no idea how volatile these are. This chart doesn't quite go back that far. This chart might actually go back of the ARK ETF. And just look at this pattern here of, think of the stages. You've got your stage 1, you've got your stage 2, you've got the blow off phase, and then it has a sharp correction, and then it has this topping stage 3, a consolidation. Everybody thinks it's over, but then the bottom falls out and you go into a stage 4. And that is exactly what happened with those stocks. When we go back here, And here are the stages, and here's the emotional state that these people are going through who don't understand price action and how the markets move. Is they're in this complacency stage. They think, oh, this is just a cool off now. We had the bear market in 2022 and we're going to go higher. They don't realize that if they're not prepared and they don't step aside, if this starts to happen, they are going to get absolutely annihilated in the most volatile stocks you could own, the ones that are going to fall the hardest. And that's what happens to most people. And the problem that drives me absolutely nuts is people don't want to listen to or prepare for these types of events until it's already happening, until their positions are down so much that they feel they can't get out. And most of the downside damage has been done and they're stuck in it. And that's like the hardest thing, is to try to show people that, you know what, you need to be prepared for this and know what to do if the markets start to roll over, because the average bear market will kind of defer your retirement by 3 to 7 years. And it's painful if you're close to retirement and now you've just lost that much money and you've got to work for another 4 or 5 years. That is pretty depressing. If you're in a retirement, you get stuck with these huge drawdowns. And most people don't know what a drawdown is, but a drawdown is how much your account has gone down in value from its highest level. And the average buy and hold portfolio has almost about a 40% drawdown. We've seen that happen multiple times through these stage 4 declines. That is huge. And when your account is drawn down and you're in retirement, you need to withdraw money to fund your retirement. You now fall a victim to this sequence of returns risk, which most people don't know about as well. And that is, you're pulling money out while it's depressed in value. And then when the market rebounds and comes back up, you have much less money going back up in value. And that's how people run out of money in retirement, like sometimes decades sooner than they expected. It is very dangerous to withdraw in a drawdown. And this next bear market could last, 5, 6, 7, 10 years. I mean, we saw from the tech bubble, it took 16, 17 years for the NASDAQ to come back, 12 years for the SP 500. It's just not something you need to mess with. You're better to be protective, potentially miss out on a little bit of upside, but know that your retirement is preserved, your financial future is there, right? That's what I'm trying to help people with, because we're in a time right now that the majority of investors are like 45 plus. They have the most wealth they've ever had. They can taste retirement. It's only a couple of years away, or they are retired. And Murphy's Law is the worst thing's going to happen at the worst possible time, which would be a multi-year bear market that wipes out their wealth, and they have to downgrade their lifestyle, everything. And whether it happens or not, you got to be prepared for it. If you're not, you're just off in la la land, and you're not truly protecting your capital. It's just so dangerous to not take something like this seriously. And I wrote a book on it called Asset Revesting. And that's what I'm trying to teach people, is you need to understand that moving to safer or to cash positions when the markets turn down is important. You can't do the buy and hold strategy. It is a very dangerous strategy for anyone who's 45 or plus. It's great if you're, a teenager, 20s, 30s, you've got lots of time. But when you're in the later stages with lots of capital and limited time, the last thing you want to do is miss out on, 5, 10 years of growth and have to downgrade lifestyles and kind of, your retirement dream.
Chris, do you think that buy and hold strategy has been, really changed by the rate hiking cycle and, the end of that interest rate cycle that we've seen for, let's say, the last 40 years?
Yeah, I think there's going to be some pretty interesting price action with the rates. Obviously, rates have been going up. We're seeing real estate starting to slow down in most places. There was 40 years of rates going down. I mean, you go from like whatever the peak was, it was like 18% interest rates, and now it's starting to go up. So like the whole financial industry that has been like born and taught about split your portfolio, stocks and bonds. It doesn't work when rates are going up. It's dangerous for both assets, as we've seen. Both of them can tumble and crumble. And I don't think the rates are going to go a whole lot higher. But it doesn't matter what happens. If we go into a bear market, stocks are going down, but bonds might end up doing very well. If the rates start getting cut, bonds are going to go up. Typically, if rates are going up, bonds go down, or vice versa. The catch here is we've got this big inflation, and so the Fed's probably not going to want to start just slashing rates, and because now it's going to create that bigger spread in inflation, and people aren't keeping up with it. So we're going to be stuck in a very difficult time where bonds could flounder for a while, stocks could continue to crash, and it could take a long time to recover from this. And it's just not something worth messing with. If you've worked your entire life, 30, 40, 50 years, why would you risk all this by just sitting there with that buy and hold mentality of this, peanut butter and jam strategy? Just spread your money everywhere and hope that if some go down, some go up. Well, a stage 4 decline, almost everything goes down. And so spreading your money around is a really good way to have below average returns on the upside, because as some are going up really well, others are still falling. And then in a bear market, they're all going down. So it's a really crappy strategy, both sides of the coin. And so I firmly believe you either are in an asset that's going up or you're in cash waiting for something new. It's way better to earn a little bit of interest and keep your wealth than watch your money go down for no reason. Or a lot of people get stuck in that whole dividend reinvestment strategy. I mean, during the COVID crash, dividend stocks were the ones that fell the most. They fell over 40% or about 40%. And that's because the majority of investors have the buy and hold dividend stock strategy, and they're the ones who are panicking. And so they drove the most stable stocks down the most. And they don't realize in a bear market, dividend stocks actually fall more than the stock market in a lot of cases. So they're actually holding higher risk stocks to try and earn their 3 or 5% dividend payment, when those stocks can fall 3 or 5% in one day and then keep falling another 50% after that, right? So you're like picking up a penny in front of a steamroller constantly with that strategy. And it really kind of irks me that the financial industry is that way, just because it doesn't actually protect the investor who's worked their entire lives. They put their money in the hands of someone who just says, oh yeah, just spread it out in stocks and bonds, and we'll just leave it there, and I'll take a cut for the rest of your life. I get a piece of your wealth, and whatever happens to your wealth, well, that's your roller coaster to ride, right? So that's the view I'm trying to get people away from, is that old style of investing that, to me, doesn't make any logical sense. If you know what the markets are doing, you follow trends, big trends, you can avoid big collapses, which is the whole point.
Right. Chris, I know that you really try to stay away from, let's say, the news and narrative to base your decisions upon. But when Powell and the Fed started hiking rates here, is there any particular strategy that you felt maybe you needed to change, or do you always just trade the chart?
I'm 100%, just on the chart. I mean, as they change the rates, they change what bond prices are doing. And so bonds are one of the assets that I like to invest in. I only usually invest in one asset at a time. So if the stock market is favorable, we're 100% in the stock market. If the stock market doesn't show signs of going higher, then we are looking either to treasury bonds. If they're not going higher, we look at the US dollar index ETF, which there's a long and an inverse. So it doesn't matter if the dollar is ripping higher or if the dollar is collapsing, we can actually move to a slow currency and actually profit from whatever move it's doing. And then if nothing meets our criteria, we just literally sell all our positions and just sit in cash in the brokerage account, collecting interest until that goes. So what the Fed does with interest rates doesn't affect us. Obviously, it's put bonds in a big downward spiral. So we haven't owned bonds. We got out the day bonds put a top in during COVID, which was pretty amazing. We got into that bonds for a 19% rally in 9 days. And we got out the day at top because it hit all of our targets, our 15% target. And that was more or less it. I mean, bonds have been out of favor. There'll be a time when they become a market leader again. But because the rates have been going up, we don't want to hold something going down. And if we do go into a big stage 4 decline, our strategy changes. We actually look to trade inverse ETFs. So if the stock market is in a full-on bear market, it's going down on average every week, we're looking to buy an inverse ETF on the index so that as the markets crumble and people are bleeding, we're actually profiting and watching our account go up by leaps and bounds. So it's going to be really exciting when we get into a stage 4 for those who embrace it, or at least those who are sidestepping it, because then you can reinvest your money at later in time at a better price. You get way bigger dividends. I remember in 2009, I bought a Canadian dividend ETF. It was paying 16% dividend because the stocks and everything were beat up. And then that ETF went up over 100% over the next year and a half alone. So there's huge opportunity. Buying and holding is such a terrible, risky way to go about the markets. I mean, the markets they're complex, but if you follow price, it's either going up, down, or sideways. You just pick the trend, the style of investing you want to follow, to how big of these waves in the market do you want to catch, and then just navigate the markets that way. That's how I go about it.
So using that, or let's say needing to be a not buy and hold type trader, is trading more often and being glued to your screen at all hours of the day so that you don't miss anything a good strategy?
So everybody loves trading. It's like a casino. It's like a rush. There's something that gets highly addicting, right? Mm-hmm. But I run my strategy because the more you trade, the more you're probably going to lose money. That's the way it is. The shorter term strategies just become higher risk. And I've created my strategy, which I call the CGS, the consistent growth strategy. It is based on, we have about 5 to 12 trades a year. We only trade big ETFs, all the most liquid ETFs, and the less is more. So, we're generating like 2.5 times the returns of the buy and hold with a drawdown of like less than 6%, where the buy and hold is a drawdown of about 40%. So we're making a lot more with just a couple adjustments a year in our portfolio, and we can avoid market crashes. We can benefit from them. It's really important to be able to do that, right? And my strategy is stuck in the middle. I do something different than most everybody. I'm not the buy and hold, and I'm not an active trader. I'm right in the middle. So active traders find my strategy very slow. They're always like, "Oh, I need more trades." I'm like, "Well, you don't need more trades, but I know you want more trades." So I'm stuck in the middle between passive investors who don't want to manage money, who don't want to do anything. They just want the buy and hold. And then you got the aggressive traders who say, well, this is just way too slow because I can't sit in front of my screen and there's not much to watch. We let these trades mature that last sometimes weeks or sometimes like 8 months, in one position. So what I do is different, which is why I think it works so well. And it focuses on protecting capital as number one. And it's not very active. And the nice thing about it is I have auto trading. So somebody can follow all the trades that I do with my strategy, and they can just link it to their brokerage account, and it can be traded for them. They don't need to learn it. They don't need to follow the strategy. They don't need to do anything. So I'm trying to make it as easy as possible for someone to say, hey, I'm going to move some money over from my financial advisor. I'm going to put 100 or 200K into a strategy. I'll let it run. If I like it, I can move more away from the advisor. And, if you move enough away from your advisor, my service actually becomes free because you're saving that 1% that you'd be paying that advisor for that money under capital. So you can diversify and move to an asset revesting strategy, which I do at no additional cost by moving some away from an advisor into this strategy. So you're kind of diversifying, but in a good way. And it doesn't cost you anything, and you can profit from falling markets. And that's what's really exciting. That's what we're seeing. We've got investors in 130 different countries doing this. And I mean, it's either they absolutely love it, it's unbelievable, or they're like, it's not active enough, I don't want it. So I'm in the middle of a transition between kind of, always working with very active traders, which I get. But to me, the real money for real big growth and protection is this strategy, which is stuck in the middle between super active and super passive.
You mentioned the word Revestor, asset Revestor there, Chris. Can you explain a little bit more about how you think about being an asset Revestor instead of investor, and why you came up with that particular term?
Yeah, good question. So I look at investing like set it and forget it. You invest in something, you plop your money in, you just leave it. It's invested. I came up with this term asset revesting because there's multiple different assets. You've got stocks, that's one asset class. You got bonds, it's another. You've got currencies. So there's all kinds of different assets out there. And then I call it revesting because we're reinvesting our money into whatever asset is performing best. And so you won't catch us buying and holding anything. What we're doing is we're looking at our hierarchy of what assets are performing best. We want to move into the best one. So we'll reinvest our money in the equities, which is what we're long right now. Once we get a sell signal, we'll be reinvesting all that money into potentially the US dollar and different things like that, right? So that's how I see it. Investing is just long term. You leave it, leave it there to kind of decay or rot and kind of, hopefully be higher when you need it, versus reinvesting is moving it into the best asset at any given time.
Almost taking a semi-active approach instead of a totally hands-off approach.
Right. Yeah.
Chris, how do you help manage the risk in some of those positions that you take?
So yeah, we use a lot of different ways to analyze the markets from a technical standpoint. The markets, there's intermarket analysis. Everything is kind of related or linked in a way. If something moves, over here, something else moves over here. And so we use a lot of price analysis. We use a lot of intermarket analysis, like how is gold moving? How are utilities moving? How are bonds moving or currencies? And depending on how all these are moving in relation to each other, it tells us if money's flowing in or out of risk on, risk off assets. So that's kind of one way. And then we look at the price charts as well. And so when the price charts on different time frames start to lose their upward trend, they start to go sideways. And then we see the intermarket analysis breaking down, meaning there's big money's rotating out of the stock market, for example. Then our strategy will be like, okay, listen, the technicals are now weak and the underlying kind of strength, the breadth of the market is also weak. This is telling us to get out of the market. And then we'll get a sell signal in the market. For example, if we take a look at the NASDAQ here with our most recent trade, the market gave us a buy signal. We've been riding the NASDAQ up through this phase. On the right-hand side is a chart here that kind of shows us a bit of our technical and our market sentiment of what people are thinking and doing with their money. There's a lot that goes into these charts, but I do try to make it as simple as like red, green, because it's either you want to be long stocks, and if it's red, we want to be long something else. We don't hold these going down. And that's the nice thing is when the trend starts to stall out, we'll get a red bar and we'll go look at something else and to put our money into. We won't hold it and ride it down. And that's the nice thing is we've got very tight stops on our positions, which I don't think you can see my chart right now, which I was just talking about. But the key here is to use technicals to get us out of the charts, out of the asset before they fall dramatically in value.
Right. Awesome, Chris. Well, I think that's a good place to kind of wrap up today's conversation, unless there's anything else you'd like to mention.
No, I think we covered a lot. I think the key here is just to understand the stock market is trending up. It's held up with it's a house of cards at this point, and we're just waiting for one of those cards to fall. And if and when it does, we're going to see most assets go down, and it's probably going to go down for a long time and a large percentage. So protect your capital. Make sure you've got some type of stop in place so that you can lock in some gains and avoid the market crash.
Chris, do you typically, going into the summer here is usually kind of a dull period for a lot of assets, metals especially. Is there typically, big market moves during the summer, or does that usually, come in that September, October timeframe?
There's usually a little bit of a summer rally. I really try to keep the emotional side down. I don't really expect the markets to do much. I just kind of let them do their thing. The more I'm disconnected from watching the charts every day, the less emotional I am. People who jump in and refresh every day and they're checking their phones, it's an emotional roller coaster ride. And the strategies I use, we're end of day strategies. So we have a buy signal. We wait till the market closes. We have to confirm, and then we send out an alert. You put the order in the next day at the opening bell. It's pretty passive, and I love my summers. I'm on the water here. I do not want to be glued to a computer screen. I built this strategy that literally I can tell usually 2 or 3 days in advance if we're going to have a trade or get out of a trade, like if it's nearing. Sometimes I can tell we're weeks away from anything, and that means you can go do whatever you want. I mean, I still update subscribers, and I follow the markets every day to keep everybody updated. But I clearly let everybody know, like, listen, we're not going to have a signal here for a few weeks, so we can relax. We're in cash. We're sitting here waiting, or whatever our position is. Don't worry about it. But the big movements usually come like September. September, the market goes into a little bit of a nose dive. Late October, we tend to see a market bottom, and then we go for the holiday rally. It's not always, but it's definitely a time. That last quarter of the year is when there's a lot of action in the markets, as people never made the amount of money they wanted to make for the year. They all go like, it's the last quarter for me to make my money back. And so there's a lot of volume, there's a lot of movement. And it just happens to be where people are really pushing a lot of money around trying to actively trade. And it usually creates some pretty good whipsaws in the market, and a lot of opportunity during that time. So summer, I like a slow kind of summer, light volume, maybe drift higher. That'd be perfect. And then come the end of this year, we go into the stage 4 decline. September, things go off a cliff and reset, which is good. It'll be a good thing. Assets are overvalued. Real estate, everything's going to get revalued again. And it's going to be a great opportunity for anyone who's preserved their capital and ready to deploy it at a fair value for new assets.
And anybody that has, hopefully been paying attention and is more deliberate about their assets, right?
For sure. Unfortunately, the masses always get caught on the wrong side of it. It's unfortunate, but it's what happens. It's part of the cycle. It just depends on what side you're on, if you're riding it or getting taken for a ride.
Yeah.
So
excellent, Chris. Of course, all of your information is available more at thetechnicaltraders.com, where you post articles and even some of your interviews and stuff, as well as some of the bigger infographic charts we went over. And of course on Twitter at the Tech Traders, right?
Yep. Thanks.
Excellent, Chris. Thanks so much for your time and your tips today.
Always a pleasure. Thanks, Tom. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.